I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Today's episode has a really special feel to it, and that's all down to this week's guest. Graham Evans is Executive Vice President and Head of International Insurance at Westfield Specialty Insurance and is bringing all that experience to bear as US Mutual Group Westfield looks to build out a globally diversified specialty operation to complement its core US insurance business. In this podcast, we assess the prospects for the London and broader international specialty insurance markets and go into detail about Westfield International's ethos and growth strategy moving forward. Graham has been working in the underwriting rooms of the London market since the mid-1980s, so has been a London underwriter, boy and man, through markets of all descriptions. His is the sort of experience that is exceedingly hard to replicate, and, listening back to this recording, it's plain that all his answers bring a lifetime of London market expertise to bear. This makes for a very enjoyable listening experience, particularly when the current prospects for the London market are looking more exciting than at any other time in Graham's long career. So listen on as Graham explains how the 177-year-old Westfield Group is planning to bring something a little different to the already eclectic mix of the London and international insurance markets. Enjoy the podcast. Graham, welcome to the Voice of Insurance.
Thank you, Mark. My pleasure to be here.
For anyone who doesn't know you, you've been in the market quite a long time. Why don't you briefly introduce yourself, run us a bit through your career and how you got to the position you are now?
Yeah, I've been in the market a very long time, a bit like you, I think. But in the mid-80s, I arrived on Lime Street, fresh from school, having suffered a fairly average career as a student. Turned up with a couple of A-levels and found myself applying for jobs and ended up on Lime Street in an insurance company, not really having a great view of what that meant.
What was the first place you worked?
I worked for a company called St Catherine's Insurance Company.
I think that was probably, I arrived in 1992 and St Catherine's may well have not been around by then.
I suspect not by then. Yes, I think it was, from memory, it was owned by a broker. It's something closely related to Minette.
Right.
But somebody may be listening to this and call me out on that. I could be wrong.
Well, yes, but we can do some research. And if there is any more light shed on that, I'll put it in the notes of the podcast. Yeah. For anyone interested in ancient history of insurance.
It really is ancient, for sure. So I'd started out with St Catherine's and really just photocopying and passing telexes around. That tells you how long ago it was. And I probably had a pretty dreary career for a number of years, as probably many of us did, just working out, trying to understand and work out what insurance was all about, but moved absolutely into the underwriting side of the business and stayed firmly in that throughout my career.
So you're a man and boy underwriter?
Absolutely. Man and boy underwriter, and always in London. So I haven't fled the centre of London for an insurance career. So some highlights is probably more interesting than talking about the nuts and bolts of my 90s underwriting career.
Well, you mentioned Aegon, briefly, yes. Aegon UK, which I do remember.
I worked at Aegon in the 90s as a professional lines, and that's probably the time when I really focused on professional lines as a business, which was most of my underwriting career was really in that sector. I actually left there to join Chubb because in the professional lines market became more of a D&O market, and at the time, the real founding companies around D&O were people like Chubb and AIG. And the wonderful thing about Chubb is they were extremely good at training people. So I think I probably took a slightly lesser job in Chubb just to actually
get the benefit.
To learn. And I think that's a really important lesson for everybody, that it's okay to do that sort of thing. It's better to try and learn things properly than to wing it, shall we say. So yeah, a period at Chubb, and then I guess a big point for me, 2003, I joined a gentleman you'll know well, John Sharman at Axis. And that part of my career certainly opened my eyes to
I suppose, again, Axis completely synonymous with professional lines, always.
Yeah, so I started up the professional lines business for them in London. So John was famously anti-professional lines for a few years, but he saw the light eventually. It was a very eye-opening experience. This was actually an insurance company that was actually exciting and interesting to work for, which hadn't necessarily been a strong feature of...
Well, certainly it was a feature of that class of 2001. They were all new and exciting and had that opportunity to really do something new across the board. Whereas, you'd say the class of 1993 had been property cat, and that was where the opportunity was. And in order to diversify, they had to do lots of M&A and lots of other things. But it was that class of 2001 that really had, the first time in any of our careers, I'd say, that someone had an opportunity to really do everything, long tail, short tail, across the board.
That's right, yeah. So a little bit more than perhaps historically being a filler for certain markets, being a US casualty
And I suppose giving someone like John Charman the ability to start with a completely blank canvas and clean capital and say, if I were going to construct an insurance company, an ideal one, what shall I do? And I suppose
Exactly.
the lasting legacy of that has been pretty telling, actually, that the class has done pretty well for itself.
Yeah, it's certainly a turnaround for everyone, I think, 2001. And being a new company at that time clearly comes with a lot of benefits and advantages, not having to deal with a legacy such as the 90s.
So after that?
So yeah, after that, I spent about 10 years there, and I decided to leave to take a role starting up Endurance's London insurance business. So Endurance was correct me if I'm wrong, 2001 in Bermudian.
Yeah,
maybe.
another one.
Yeah. And didn't really have a London presence. So they had a small reinsurance business, but nothing on the insurance side. Started up as the CEO of that business to really build them a specialty franchise in London. I had a great and interesting, varied experience there.
And was that before Mr. Charman came knocking again?
A little bit before, but not very much. In fact, he joined Endurance while I was on gardening leave between Axis and joining Endurance. So that was not known to me at the time of taking the role, but it was certainly, in terms of starting a London business, a positive for the...
Yeah, absolutely.
So yeah, I had a great time there, and we went through some acquisitions, specifically bought Montpellier, which from a London point of view was interesting because we were a non-Lloyd's business and it gave us a Lloyd's syndicate.
Yeah.
And then eventually we were acquired ourselves by Sompo in 2017. But a lot of that was effectively, from a UK and European perspective, was a reverse takeover. So my role there was really to bring that business in, which was a very different business, being
absolutely,
really a Japanese interest business rather than what you might traditionally see in the London market in a specialty insurer.
So we're coming up to date now?
Yeah, pretty much. I had a bit of a gap. I left Endurance, took a break, basically. It was pretty full on there. And actually, I coincided with COVID, so I had a year off during COVID, but couldn't really do much with it. So I ended up having a couple of years out.
Shame you couldn't really go travelling or anything.
Exactly.
See the world, no.
I had planned, but everything got cancelled, so as you can imagine. And after a couple of years, I was looking at what options might be available and thinking, really, I'd like to do something interesting. So Endurance was very interesting, and that's a business that I built from scratch. So I hired at least the first 200 people or whatever. So there were opportunities around in the market, but I was looking for something that would look a bit different and feel a bit different from what I'd done previously. And Westfield got in contact with me through a guy I'd known very well in the past, a gentleman called Jack Kuhn, who I'd worked with for a long time, and said, well, look, here's this 176-year-old mutual called Westfield, which I have to admit I'd never heard of them. We just entered the specialty market in the US, and the next step for us is really to look internationally. And what do you think about that? Well, I can tell you a lot what I think about that. What do you want to do? So, yeah, that's how we started the conversation.
You always start by saying, I'll tell you how you shouldn't do it.
Yeah.
Because, of course, things that make a lot of sense sort of on paper in insurance are often very much harder to execute.
Exactly. So the two choices are quite simple. I mean, it's start from scratch, choose Lloyd's or company, but different strengths and weaknesses around that, or it's buy something. And as you say, if you're going to buy something, be very careful about the legacy of what you're buying. Even if the front page looks good, make sure you read the small print properly. Yes, I think it was a nice opportunity.
So you were in sort of on the ground floor there.
Absolutely.
Before the acquisition of
Yeah, so I joined in order to take part in it. Ultimately, we talked about acquisition. I joined in order to do the due diligence.
That must be really exciting. Presume that's not something you'd done in your career before. You started a division from scratch, but you hadn't bought a company before.
No. So we bought a company when I was at Endurance, but I probably wasn't as deeply involved in the acquisition because it was essentially a Bermudian acquisition. So the opportunity to buy a London business standalone and to take that subsidiary out of its group was a fascinating experience for me, absolutely.
So Westfield Specialty International, is that the way we should always describe it? Should we just say Westfield Specialty? Is it okay to abbreviate it to that? Or how do you all describe it yourselves within the group?
Well, both is the straight answer to that, Mark. Or even just Westfield. That's okay too. So that's certainly the easiest one to use. But Specialty International is the London business, and beyond London, we have a Dubai operation, for example. So it's really the non-US business. We have a specialty business in the US, and we're very closely aligned to the whole of Westfield Group, but very closely aligned to specialty US, obviously. Similar product setup.
And how does it all fit together? So obviously the ultimate holding company is a US Mutual.
Correct.
And then in terms of your relationship with Specialty US, are you both just wholly owned subsidiaries of the same thing, or do you report into Specialty US, or how does it work?
So we're a subsidiary of Westfield Group, as is Westfield Specialty in the US. But obviously, being a Lloyd's business, we're very much a separately capitalised, separately regulated and relatively independent business from a board and operational perspective. So, for example, something we've been through in the last couple of years, in the first couple of years of the acquisition, was really uncoupling the syndicate from its old parent and recreating an independent platform for the London business to operate from. So a lot of that really looks like a standalone company rather than a subsidiary, but we're very much a subsidiary of Group. And part of the other challenge is to ensure that we create our own identity in London, but we're also aligned closely to the interests of the Group.
And presumably, I suppose you can't have a Lloyd's business without writing US business. That you're autonomous in your writing of that US business, or are you trying to sort of work together with Westfield Specialty US? When presumably you don't want to end up both writing the same thing or competing with each other for the same piece of business.
No, exactly. We have a collaborative approach to that, should we say. So we certainly have appetite to write the same business, potentially, but only with the right level of communication and understanding of how and why we're deploying capital from more than one place. So it's important to us to get the decision right at the level of the broker to make sure that we're consistent and thorough. But yes, I guess you can be a Lloyd's business without writing a US business, but it's going to be a smaller Lloyd's business, isn't it? You know,
every time I look at the annual results, it's always about 50%, 51, 52
That's
or
right,
something,
yeah.
isn't it? So it's half the business.
It's significant, yeah. So it's probably important to say that the bit that we don't do is we don't write US casualty business out of London, including professional lines. So that's actually been a theme of my career since joining Axis, that we're better placed in London to focus on that while the people in the US focus on the US casualty. So we probably cross over on what we would generally call short-tail business rather than long-tail business.
And in terms of Westfield as a group, obviously it's not necessary for me to ask you. I probably should ask Group what Westfield Group's all about. But it's obviously, just looking from the outside, I suppose there's a familiar story. There are other equivalent businesses, Lloyd's businesses, owned by big mutual groups. Often there's a philosophy that the mutual is the mutual, and you're here to help strengthen that mutual by giving it profitable lines of business and a lot of diversification, of course. Is that sort of how it works?
I think so. I mean, the thing is, when I joined Westfield, what I liked was this 177. We just had our 177th birthday, by the way, just a few days ago.
Congratulations.
Yeah. I feel 177 sometimes. But the important thing for me was the philosophy of Westfield is incredibly simple. And I really like that. Really, the company sees its role as to deploy surplus capital for the benefit of its policyholders. It's an extremely simple philosophy. So from my point of view, what does that mean? What's our role in that? Is important to establish, but our focus is on establishing a strong company, a strong and capable company in London that's able to make predictable returns, which is a challenge in specialty markets over the long term. So really trying to align to the core mission, if you like, of the group in a way that is representable in a Lloyd's market where it's a different environment from a regulatory point of view. Lloyd's certainly has a view on the profitability or not of its members. So to me, that's a fascinating thing for people who joined us and who have joined us over the last couple of years is, as a mutual, clearly you're not driven by the quarterly earnings call. Clearly you're not worrying about what your 6 largest competitors are doing in this space and why aren't you doing the same thing or why aren't you doing the opposite thing. You're really able to focus on yourself. Hugely long horizon in a company like Westfield and a level of patience to achieve. They're ambitious, but patient with it. So it's a very nice environment in which to think about growing a business and doing it properly.
It is a very valuable commodity, patience in insurance, as perhaps people who've been around in it long enough know that it's better not to be in a hurry.
Yeah, well, having spent nearly 20 years in a Bermudian public company working with John Sharma, I'm used to impatience.
No, that's absolutely true. I suppose act in haste and then repent at leisure is, especially, well, in long tail lines, obviously, as well. You know all about that.
Yeah, absolutely. Well, tread with caution is always the right way to go. And as Jack always says to me, Jack Kuhn always says to me, slowly wins the race. I think he has a hare in the tortoise type of mentality, particularly with his longer tail background.
Well, I suppose that the tortoise can still be feverishly preparing for every next step, but they know that there's a time to do that next step, and not necessarily the time might not be now, and the time for patience is always good.
Yeah, and we have a really clear view on what we want the business to be in terms of the products we want to be in, the markets we think are credibly long-term markets that we can operate in forever, because we consider ourselves a forever company. But we have the freedom to take our time with that. So I think it's important to establish a product set and especially to establish expertise and people in the right places to support underwriting that business. But there are many examples right now, even in a relatively high point in the market, where we just don't need to go there in terms of we don't need to force the growth. So you mentioned earlier, I think before we started recording, around the D&O market, but yeah, that's a tough place to be at the moment. It's a profitable market, but it's a tough trading environment, and to force growth in that area right now is not a wise thing to do. So we're represented in it. One of the many things we added since I joined was a D&O capability. We have the confidence to do that the right way, not the wrong way.
keep your powder dry. That's certainly over the last 3 or 4 years, isn't it? It's been a head scratcher of a market. But markets don't always behave rationally, and I'd say that D&O is one of the ones that is proving that in abundance, isn't it?
Yeah, I've been a D&O underwriter for a number of years, and I feel it's one of the more cyclical markets, shall we say, one of the more cyclical products, probably because of the way the programs are structured. But it's hard to understand sometimes what people are thinking, as was expressed by Patrick Tiernan quite strongly, not so long ago.
Certainly it was, yes. I think he used the word moronic, which is very strong for someone in his position. There you are. I think that's fair enough. And it sent a very clear message to think twice before they double down on anything.
Yeah.
So before we go into more about the detail of the strategy that you've got, it's good to paint a picture of where the market is. Would it be right to say, that's most of the commentary I've had on this program, or obviously we have the kind of way staging posts in the market, the 1-1s that we've just had, that the market might be past its peak in terms of pricing. Is that a fair starting point? We know there's so many cycles within cycles, and obviously D&O seems to live in a world of its own.
Yeah, so I'd say that in 24, across the portfolio, we saw a rate increase. And we've seen the syndicate has seen year-on-year rate increase for a number of years. But equally, I think it's probably fair to say that we're moving through the peak right now. So 2025 early stages looks a little bit more competitive than 24. So it's perfectly reasonable to say we're slightly beyond the peak, but we are at possibly a relative high.
But it's a good place.
It's a good place. It's a volatile landscape, and let's not talk about politics, but there's all sorts of things going on in the world that create a lot of risk. But our view is that actually the opportunity and risk are pretty well balanced currently at this point in the pricing cycle. Therefore, it's a market we're willing to grow in and really to think about opportunity to diversify and improve our portfolio.
There's still plenty of opportunity.
Absolutely. And that's really what keeps us interested in growth.
So there, going more into specifics, what's the strategy? Obviously, not US casualty, because that's one of the red lines. But otherwise, the world's your oyster. Yeah,
it is, in some ways.
What are the good bits anyway? What are the bits you're most pleased about or excited to be getting involved in and thinking, well, I'm looking forward to building this new arm?
I guess it starts from a place where, put it really simply, we're really trying to increase our relevance in this marketplace in particular. And of course, this marketplace is completely global. So that can mean many things. That can mean growing the diversification of products we have. It can mean growing the diversification of geographies.
And also relevance could be that we'd like to write much bigger lines in the things that we're really comfortable with as well.
Yeah, there is a balance there for sure. You say, I want to be relevant in the energy market and I've got a $5 million line. It's probably not going to get you very far, So
No,
I think...
absolutely. Yes, I think every broker's been there, tear your hair out, 2.5 hours, sort of, you finally win somebody round, and then you realise that they're only going to put down a 2% line, and you've wasted your time.
Never having been a broker, I can never understand the disappointment.
I know, I should have known that they didn't have
grandly offered you a 0.5% or something. I can understand that. But I think for us, brand recognition, really getting an understanding of Westfield to clients and brokers, actually, in the first 2 years, a lot of time was spent transitioning the business and understanding what products we needed and if we had the need to upgrade certain elements of the business from a staff or systems point of view, putting that in motion. 25 and 26 is much more about getting out there. So we're confident and prepared for a much broader offering. We want to be sitting at the right tables at the right times to be in certain negotiations. And I think we're now in a place where we can do that. The dreaded distribution word is key to us looking forward to really make sure that the people we want to deal with understand our proposition, understand what we're thinking and how we want to work. The line sizes, things like that are just a byproduct of that type of thing.
Actually, just as a kind of recap, where are we now in terms of the size of the Westfield Specialty International operation, in terms of just GWP and headcount, that kind of thing?
So we're an $800 million business at the end of 24. Important, I think, to state that there has been growth since the acquisition. So we're around about $200 million bigger than we were at the point of acquisition. And our staff level is around 215, I think currently, maybe slightly more. It's been moving reasonably quickly, as you probably understand.
Yes.
And a little bit more to come in that regard. So, we've got a high level of interest in underwriting hires in particular to build that diversification of products. So a stream of hires to come in towards the end of the first quarter and into the second quarter. So we'll be heading towards that 250 number, I would think, by this time next year. But really important for the business has been the syndicate. The other thing I haven't mentioned, I suppose, in that transitional period is to really secure our profitable base and our profitable business, which clearly is an important thing. And the syndicates will post a good profit for 24, and that's the 4th consecutive year for the syndicate profitability. So I think it's in a good place to invest and to think about the future.
And sometimes it's some of the best advertising you can do is make plenty of profit, and it does get buyers' attention. Yes, people don't want to overpay for their insurance, but at the same time, they don't want to deal with people who are dealing with losses year after year and compounding losses year after year. You think, well, maybe I shouldn't be insuring with them. I'm not sure they're going to be here forever, are they?
Well, it's always a difficult conversation, right, with a client. But my view is the best proposition for a client is a stable, profitable business that understands what it's doing and provides a great service and a great outcome. That should be key. But you won't be able to do that if you're not making money.
Well, I mean, not every customer wants that. They just want the cheapest deal sometimes. But generally, yes, the better customers, they want to deal with sustainable people who are going to be there, and someone they can really invest time and build a relationship so you can both get to know each other and really get more comfortable with each other and really trust each other because you've been working together for 10 years.
Yeah, absolutely.
Every broker's had customers that everyone knows, the ones who are just going to dump everybody because they can get 20 points off. And they're difficult customers. Ideally, you prefer the ones that you can really build that relationship with and spend the time with. So one thing in terms of expansion, I was reading the press recently, was reinsurance that you were looking to build out a little bit, that you were a little bit underweight in. Run us through that.
It's always interesting when you talk to the press.
Maybe that's just what they ran off with. That was the interesting bit.
So a little context is probably a
well, that's the good thing about a podcast.
So.
You can take it out of context and sensationalize it if you want to. But in the end, we're going to talk about this for 45 minutes. So we won't be able to have things out of context.
So what we're doing very much is we've established 6 divisions within underwriting. Well, there's 6 divisions in which each of which we have an appetite to diversify, increase our product, and ultimately grow our business through those methods, both geographically and through different lines of business in the Lloyd's market. Reinsurance specifically, what we've actually done there is shrunk the portfolio from what we acquired. Part of that due to some appetite concerns, and part of it due to we lost a couple of staff there, but it was a very concentrated portfolio. I think as we look forward, we're very open-minded about growing that business back up to a size at least of what it was when we acquired it, but perhaps larger, but with an open mind to diversifying the income streams within it rather than being really focused on a couple of places.
Oh, you don't have a kind of ideal split, insurance, reinsurance in your portfolio or that kind of thing? Or are you more organic about that approach? Or
Yeah, we're pretty relaxed about it, but I would say we're not a company that wants to have anywhere near 50% of our business as reinsurance. We're pretty set on being insurance focused.
Right.
With a complementary reinsurance portfolio, absolutely. And as a buyer of reinsurance, we certainly see some pretty attractive terms in the market for a writer of reinsurance, and we're interested in that dynamic.
Yeah, it's a pretty good market, and there's plenty of demand. So
yeah, absolutely.
And another class I was reading about was accident and health. Run us through that one.
So A&H is already in our locker actually in London, so it's not a new product for London. I think what you've seen is a reference to the US strategy. Okay. So US Specialty have recently hired a leader for A&H. I think there is an opportunity. We work very closely with Specialty in the US, so that's definitely an opportunity for London, which we're really in the very early stages of thinking about. But for me, I see A&H as an obvious area of when we talk about that reinsurance strategy and diversifying that as an obvious area for our reinsurance team to be thinking about, perhaps more than our insurance team.
And anywhere else you sort of survey the world and think, wow, yeah, I'd like to be getting into that in 25, 26?
I think there's plenty of products that we're not particularly active in. Cyber would be a great example. The key is really, can we find a strategy that makes sense to us? We've looked at aviation, for example, and we haven't taken the plunge on that.
I've always found it hard to have aviation make any sense.
Tough to see a winning strategy there that isn't driven by scale.
Yeah.
Whether that's a winning strategy or not is another matter. But so for us, we had a flirtation with that, and it's certainly something we would think about again, but it's marrying a strategy that we can believe in to a team or an individual who we think you can deliver it, and that's what we're patient about.
It's getting the right person. If you suddenly thought, wow, this person's available and interested in joining with us, and they like this philosophy that we've got, this longer term, less kind of let's build something in 5 years and sell it to someone else type way of doing things.
Exactly.
So culturally, you're looking for those sorts of people who want to build something that's permanent or sustainable, semi-permanent, 177-year type permanent.
So one of the buzzwords that appealed to me again when I was first talking to Westfield was the concept of stewardship. So Westfield is very centered around, they are stewards of the business for the next generation and the generation beyond that. So I think we really like that word. And really the concept of that when we talk to underwriters about portfolios that we could create that really live beyond them, that we really hire younger people in who can really then progress through the company and take that on. I think that's a really strong proposition for graduates and the younger population, that in 20 years' time it's not going to have been sold to somebody. It's going to be continuing to thrive, and the opportunity will naturally fall to the next generation.
It's that idea of taking something and making it better and then handing it on to the next. And hopefully you want to leave it in a better condition than when you started.
Yeah, even if that means that from time to time in the more volatile areas, it has to shrink to remain a good business. And we're absolutely committed to that with our underwriters, that, you know, the old adage of paying you to sit on your hands is a challenging one, but nonetheless, adjusting your portfolio to the market is a really important thing, right?
I've probably interviewed 100 CEOs who say that they would do that. But when it suddenly see their expense ratio ballooning at the bottom of the soft market, particularly if they're publicly quoted, they're under a lot of pressure from the analysts. And I don't think they ever actually do that. So just write some of the good business.
It's a tough one to make that up, isn't it? You know, particularly, as you say, particularly in a public company, or even worse in a private equity owned company, I would think. So
it's an interesting philosophy, though, in terms of attracting those people. You want to attract people who want to build something, not necessarily build and then blow out and buy themselves a yacht in 6 years' time. So you probably, hopefully, you can save up and buy yourself a nice yacht at some point. But it's a different type of business person that you're looking for, rather than that kind of, hey, look, if you do this in 5 years' time, you could have, bags of money.
I mean, we'd all like that, right? I guess some of the common ground we're looking for is, one of the things I think about is the motive of capital. So what's it here for? And I think we're in a phase where there's a lot of new markets turning up in London and elsewhere. And there's a lot more intermediated underwriting going on, if you get my gist. And I think a lot of that is backed by private equity or sources of capital that have an obsession with EBIT or valuation. So the question for me is, well, clearly that's not us. And we think there's enormous value in how we're presenting our capital proposition and what the motive of our capital provider is for longevity and durability. So the question is really, are you a F1 racing driver type of underwriter, or are you somebody who likes a classic car? Or maybe the way to think about it. But
I haven't asked you about delegated, but obviously it's always a feature of, to a greater or lesser extent, of any. Yeah. What's your delegated strategy? Things have always been moving around with the MGAs, but obviously we've had the growth of these hybrid carriers and all sorts of interesting things, and some broker related, some not. Hybrid carriers of directly connecting MGAs or aggregates of MGAs to reinsurers, for example. What's your delegated strategy within all of this? Would you rather be an open market underwriter most of the time, or your delegated is much more conservative?
That's a great question.
Because I'm just picking up on what you said.
We have, and we acquired a really excellent delegated business. So when we acquired the syndicate, probably 2/3 of the business, the premium income with the business, came from delegated relationships. So we have a plethora of really great relationships with MGAs and the like. Typically, the strategy has been focused on faraway business or on business in a level of expertise that is difficult for us to achieve or too expensive for us to bother achieving when we can support somebody else. And we value that. So an interesting message for me actually as the incoming CEO was to look at that portfolio and speak to the underwriters about the need for us to increase our relevance in London and fortify the business for the longer term. So we were underweight open market. We were underweight certain products where the most of the business is likely to be open market because of the size and complexity of risk. So it has been a focus with the teams we've hired and individuals we've hired to build on our open market capability. And effectively, from my point of view, that is just giving us greater resilience in the longer term and making us more relevant directly in London. But we highly value the delegated business we write. A lot of it is price submit, lead basis. We have quite a lot of underwriting control in and around that business. But probably one of the secrets to being good at delegated business is to be good operationally, to be able to manage it properly and make sure that the fundamentals are in place.
You know what you've got, and
you know what your risk is. You know where your money is.
Well, it was always some sort of delegated relationship that only about 8 months after some natural catastrophe somewhere would have discovered that XYZ syndicate was now looking at a reasonably large loss from a hurricane or something that they really did have expected they would be on. Yeah. Because of
absolutely
a lack of control around exactly what those delegated.
That's the nightmare scenario with delegated, right? So I think the other thing for us is it gives us a lot of exposure to smaller business, which acts differently through the cycle. Typically, I mean, we probably expect to see less price reduction in the shorter term than we might in the more volatile, larger risk area, where perhaps it's a little bit easier to break into. So it just gives us a different part of the portfolio that's significant, that we can perhaps be a little bit more predictable.
And now with the technologies available, you're ingesting that information. Hopefully you're not waiting for everything to come 3 months and then 3 to 6 months before you actually know what's on. These days, there's quite a lot of technological solutions for having a nearish real-time view of what's going on, if you want to drill down into it.
Yeah, absolutely. I think it's pretty transparent now. The things that with the MGAs that I feel less excited about is when there's a person sitting in Lime Street who's an MGA for D&F business coming in. I'm thinking, well, why have we added to the chain there and what's the motive of that?
Yes, you need to have a good understanding that that is going to add. They better be really good, haven't they?
Yeah. So yeah, I puzzle over that. That can look a little bit short term to me. An opportunity in a high market to make a bit of money quickly.
And how do you feel about this shift that we've had in the distribution? A big shift into excess and surplus lines, but also a big shift into some of those MGAs. Do you feel that's one of those things that is cyclical? A lot of people would argue that some of that is a permanent change, in that things do change and things have cracked and changed permanently. But then often we've been around long enough to see that some of it's cyclical. I wonder where you see that balance and how much of it's cyclical, how much of it's a permanent change.
It's really hard to say. I think it's that's a great question. If I had a crystal ball, I'd be really good at this.
I'll ask you again in 10 years' time, and we'll already know the answer then.
Yeah, I suspect the answer's some and some. There are some really great MGAs in this market and overseas. I think if you have the balance of great product and great people and service, then you should be able to survive in either guise, and you should get long-term commitment from your capital providers or your reinsurers. I think it's just working through the good and the bad is going to be what will happen through a softening market, where if the reality is it's just more expensive to write the business in one way than the other, then it's not going to last.
This was a sweet spot with MGAs, a way of aggregating capital, to try out new things, to aggregate the capital behind some specific expertise, which you think wouldn't be a big enough opportunity for any of those individual capital providers on their own. But now somebody's got this niche and that they've made the effort. Yeah. And they're really adding some value because they really know about this particular niche class, for example, or a new emerging class. It seems to make a ton of sense, and it makes sense for everybody. And I suppose you can only have the chain arranged a certain way if it makes sense for everybody. And in the end, if it's not making sense for you because you're losing money, then you're going to have to break that chain, aren't you? You're going to say, well, I'm going to stop doing it. Yeah. So it works when it works.
I think it's a really good point. They can tend to be good innovators, and a lot of insurers in and around Lime Street maybe aren't great innovators. So the ability to take slightly less risk backing some agency to innovate is an interesting one.
We look at something like cyber. It was a classic case of some of the cyber pioneers were MGAs, and it makes a ton of sense.
Yeah, and the biggest complication is the aggregation risk. So to spread that among a large number of insurers is a great way to deal with a problem that balance sheet insurers are going to struggle with.
And that's something that matures in the way that cyber is going to and has done already. Then I suppose having your own open market version of that, as the class gets so much bigger, it also makes a ton of sense. And also you've learnt about it.
Yeah. Well, it's key, isn't it? So part of what we're trying to do with diversifying product is to appeal to customers across more than one. And which customer doesn't have cyber on their mind? It's something that probably affects every single buyer we talk to.
Yes, you want to be relevant. I suppose you've got to consider it, haven't you?
Yeah.
We've had some loss activity. Well, we're always having loss activity. Obviously, we had Hurricane Milton last year. Now got the LA wildfires. We're talking about a market slightly past its peak, or feeling like it's past its peak. Do you think this is one of those ones, some of these events are going to slightly temper some of that appetite, that competitive appetite and the appetites? Was it too early to say? We're seeing quite a lot of big numbers coming from the LA wildfires, for example.
Yeah. I think it is a little bit early to say. I think the wildfires, I'm sure, are likely to cause more of a challenge in insurers' minds and reinsurers' minds than perhaps the wind.
I suppose, yeah. And from a specialty perspective, we've got anecdotal evidence of a lot of high net worth and potentially specie, fine art, that kind of stuff.
Yeah.
Creeping in, and obviously things that probably take a bit longer to filter back to London, for example.
Yeah.
Do you think there's a possibility of that being an event for some of those classes?
I suspect it's a surprising event for a number of classes that you mentioned. I think the reality is that every cat is a learning experience, and
they're always different.
They expose poor underwriting, right, or poor risk management, or whatever it is. There's usually an outlier, or there's a surprise loss.
In Sandy, there was an art dealer who kept a whole lot of stuff in the basement. Absolutely. And it was all soaking wet. And
the assumption
you thought
was
that wasn't a very good idea with
hung
hindsight.
on the wall, and they would have been fine, right? So it can be really simple things, can't it, that get exposed by.
I suppose yes, and that's what sometimes yes, as journalists we're there to sort of mop up and find all these interesting stories in a big event. Even in the 6 to 8 months to a year afterwards, we find out all the things that happened.
So I spent, as I said before, a long time as a D&O and a financial institutions underwriter, and I used to go and talk at conferences or to risk managers and things like that, and they're excellent at figuring out where all their risks are. And banks in particular are pretty well risk managed. But I would always say to them that the biggest risk, and I think the reason why you buy these products, is hubris. And I think that's what happens, particularly in, shall we say, higher margin business. So the event that's going to hurt just gets further away every time it doesn't happen, and just gets further away from your mind. It's easier for clients and brokers to broaden product and change the way that you might write the business, and they all bring additional risk that you don't necessarily see because you have a comfort that you're pretty well away from.
If your retroactive data is getting further and further into the past, there's more and more exposure, and you never quite know what you're going to find.
So I think that the interesting thing with specifically about those events, or in particularly the wildfire, is I think people have probably become quite accustomed to having good Q1. And there are probably going to be a few people who are not going to have, and that's a bad start to the year.
Q3, Q4 are bad, but Q1 is supposed to be very nice.
Quiet quarter, right? So not so much this time, I think.
Talking to sort of wider market topics, we're in an interesting period at the moment in London that I don't think I've known a time when we were just about to get a new Lloyd's chairman. Obviously, we know who that's going to be, but at the same time, we're going to get a new Lloyd's CEO. They tend to sort of give a couple of years before one moves and then the other. In that sort of time, often you get a time of sort of market canvassing, and you might be summoned into some nice fireside chat or a lunch or something in that first 100 days type scenario. So if you were canvassed and asked, right, Graham, we're new with the new team, what would you like us to do? What would you say? What would be your first sort of top of your list of things?
Well, I'd say thank you for asking me that. And I'd say first and foremost, don't just talk to me in the first 100 days. It's well known that market participants are keen on continued change and improvement in Lloyd's on many levels. And I do believe that that can be really effectively done with continuous communication.
Would you say keep going, doing what the previous team was doing and just execute that?
So there's some really good initiatives and really good talk, and particularly people like Patrick and Rachel, I think are saying some really good things, and it's interesting. My wish would be push it through. Let's get to that point and let's get there quickly. I think making change in an organisation of that size must be very complex and just takes a lot of courage. And sometimes that's easier for a new management team than it is for the embedded team. So continue that path of change and push it, is my view.
So what sort of things would you like to change, and how much would it be just about executing what's already on the table?
So in general terms, reducing bureaucracy, reducing cost, thinking about how we can support each other, thinking about whether a number of 100 billion is an important number or not, and what it really means to go there, thinking about why I say come and talk more to market participants. We all have a different proposition. We all have a strength that we feel is important, so we're all going to argue about that. But be thoughtful about the motive. Like I said before, what is the motive of capital coming in? It could be capital coming into Lloyd's, or it could be capital that's being supported by Lloyd's through delegation and the rest of it. I think those are all important things.
In terms of the technological side of things, I suppose certainly my canvassing of the market would be that everyone wants this to be ready and finished as soon as humanly possible.
Make quick decisions about what's achievable and go and achieve it. I'm sure people are bored of talking about it, but to be fair, it's probably a phase of herding cats going on there, but I think people are pretty aligned in terms of what they want next.
I would say if it was 30 years ago and we were talking about EPS or something like that, electronic placing support and those kind of things, we would have had conversations in the bars of Lime Street. There would have been at least half the people say, well, it's never going to happen, or I don't want it to happen. I don't want to change. I want to carry on using my slip and walking around. And we don't have those kinds of conversations anymore. It's much more, well, why hasn't it happened already? And let's just crack on with it. Because we can all see the advantages of what we can achieve if we do get this all sorted.
COVID was an inflection point, right? Because until that point, everybody believed you needed to be huddled in Lloyd's to do a deal or around close by. And of course, the minute you can't do that, you do get some change. You do get a change in the approach and an acceptance that effectively, in a very simplistic way, that's electronic trading, isn't it? It may be happening in a very old-fashioned way, but it's still breaking a barrier. And so do we wait for an event where we have to do it, or do we just get it done?
Technologically, lots of things have really moved on. And in terms of, I wonder what your view is on some of these semi-automatic follow type facilities, those which have proliferated, but there's so many more consortia. They're all slightly different ways of doing almost the same thing. How far do you think that's going to go? Are we going to end up with a market with just a couple of leaders and then the order is filled sort of by buttons being pressed?
I really feel, Mark, that we've been there before, not in a digitised environment, but the onslaught or continuation and growth of automatic follow facilities is probably started
every major broker's now renewed one, and it's certainly growing. And of course, let's say the ones of the 1980s and 1990s, I probably spent a lot of time as a journalist writing about the court cases that they engendered.
It comes to my point of hubris. It's not about what it's doing for people now at the top of a hard market, when it should be relatively easy to make money, even if you extract more cost before it gets to the underwriter. The question is really, what does that mean in 5 years' time in the event that a competitive environment increases, capital comes in that wants to create its own capability and wants to service its clients properly? I don't particularly see that ending any differently. What you're really doing is reducing margin.
What do you think the market's going to look like in terms of how many leaders in the open market are there? And presumably also, the brokers and the clients want leaders. Every client and every broker wants an alternative leader, and hopefully you want more than one. You don't want to be stuck with a kind of monopolistic situation because this is the only person who's really good at this. The only person that anyone follows is this.
I don't think it's going to look that much different. There's plenty of opportunity. As I said before, we're in a complex world. We think risks keep changing. The same risks aren't necessarily the risks of today and tomorrow, but they don't seem to reduce. So, the need for insurance in complex specialty classes, I think, is going to continue to rise and therefore create opportunity for everybody. I think that digitised automatic follow has a long way to go to prove the value of that. And I'd be happy to be wrong. It will mean there's one leader in Lloyd's and there's one leader in the company market and one in the US, but I doubt it.
Yes, I think you're probably right, because, of course, anytime that would be inefficient in its own right, because it wouldn't be enough competition. So the market by its own dint would create some competition for that leader.
Yeah.
If that leader was suddenly swinging these billion-dollar lines and the London whale of D&O, brokers would realise, well, hang on a minute, this doesn't work very well, does it? Because they're dictating terms and it's not very competitive. So this doesn't make any sense. We need to create an alternative leader. So let's get behind someone else.
It's a natural outcome in a competitive capitalist marketplace, right?
I suppose the one thing we do know is it will always be competitive.
Yes, and let's hope so. I think competition is good for us because it ensures that we think very clearly about the risks we take and we present a proposition that is meaningful, not lazy.
We couldn't be sitting in 2025 without talking about artificial intelligence of some description. Where do you think the best applications are in the insurance value chain, particularly in the specialty insurance value chain? What sort of things have you been experimenting with?
So as a group, we're inquisitive. Certainly, I would say that's a great benefit to this business from Westfield Group, is that they have resources and have done quite some time focused on this. Our view is we like the idea of creating operational efficiency through the use of AI. We don't like the idea of underwriting with AI. So everything that I've done here in the last 2 years has been focused on really bringing people together and making sure that we have the right talent in the right place, making sure that we create an environment that people are happy in, people are enjoying doing their work and creating something together. Having that relationship with a computer might not be quite so endearing.
Would it be more, therefore, the things that enhance the human side of things, that get rid of a lot of the boring stuff that we all have to do?
Absolutely. If it's contract certainty, if it's triage of submissions, if it's the interplay between pricing and underwriting, if it's machine learning and reserving or those type of things, that's really interesting because we can create a better outcome and a more efficient outcome by using technology.
Well, somebody's going to read all the wordings on a treaty submission. That'd be amazing.
You probably had to do that yourself in your day, did you?
Yeah, we certainly did. It was actually miserable. And all the wordings was just sitting in a corner of the office waiting to be agreed when it was exhausting.
I have this sort of slight theory that the larger you become, and I'm talking about very large companies, you talk about how important the customer is, but you don't mean it. So, you don't really, I don't want to get myself into trouble, but if I use my bank or my favourite airline as a good example and I try to interact via a bot with them, it's a deeply unsatisfactory experience every single time I do it.
Yes.
So that, in my mind, that says, well, who's really making this work at that point, at the interaction between a customer and the company?
So you'd rather that would be a Westfield underwriter?
To me, that's a human-to-human
Westfield claims manager.
Claims and underwriting in particular, where, of course, the most interaction takes place with third parties and clients and brokers. To me, that we're absolutely committed to that being a human experience.
I'm really glad to hear that. Graham, I've come to the end of my questions. I've really, really enjoyed talking to you. Thank you so much, and good luck with what you're building here. It seems really interesting.
Well, it's been my pleasure, and thank you for having me on. Appreciate it.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.